For those of you who don't know me, I'm Bob Steers, and it's my pleasure and privilege to welcome you to this year's Luminary event here at Georgetown University. It's my great honor to introduce a longtime friend as our luminary this year, Scott Rechler. But before I do that, I want to thank Jeremy and the Real Estate Credit panel. That was really good stuff, really helpful, really interesting. So thank you again for that. So as we were thinking about this year's luminary and thinking back to last year when Howard Marks was here and he shared with us his latest thinking in his piece entitled Sea Change, where he essentially made the case that after 40 years of declining interest rates, he declared that period over a year ago, more than a year ago, and made the case that higher for longer was the old normal, it's back the new normal, and it's going to stick around for a while. And there were obvious implications for real estate back then that were not as obvious, but we now know that the Odyssey NCREIF index has just turned in its sixth consecutive quarter of declining or negative returns. So for those of you who listened to Howard last year, you might have avoided some losses. So in thinking about this year, we asked ourselves, what is the most pressing, controversial, important question facing the industry? And it wasn't a long discussion. Office was the obvious topic that we wanted to address. And in thinking about it, we wanted to address the question as to whether the glass is half empty, is it half full? For office in particular. And the challenge, I think, is to decide, is the glass half empty, half full? Will this be a good vintage year, or is it going to take 5 more years? I'm not sure anybody knows the answer to that question with confidence. But as we all know, on the glass half empty story, and that's the easiest story to make, we're starting with a national vacancy rate of 18%, an availability rate of 25%, both historic highs with little hope for any near-term improvement. Office REITs have been in decline for years. Presumably they're a leading indicator. And post those declines, the office sector represents less than 3% of the NAREIT, the listed REIT index. Just giving some on-the-ground context on the glass half-empty case, if we were to return to pre-COVID absorption rates today, it would take San Francisco 10 years to get back to 2020 occupancy. And in some of our earlier panels, we talked about the similarities to the retail apocalypse, where it took fully 10 years for a lot of obsolete space to be dealt with. Turning to the glass half full, that's a little tougher. The only fun facts I could come up with really relate more to green shoots and hope. New York City trophy office is actually seen a tick up in occupancy, and since 2020, rents for trophy are about 8 or 9% higher over that time period. Getting back to the listed market, though office REITs have been the worst performers for many, many years, the last 12 months, office REITs are the best performers, with SL Green up 150% and Vornado up 85%, both New York City-focused companies. So getting back to, is the glass half empty or half full, or maybe a little bit of both? We couldn't think of anyone better suited to address this for us than Scott Rechler. So I'd like to welcome Scott here tonight. And for those of you who don't know Scott, and this is going to take a few minutes, so buckle up.
You can cut it short.
Yeah. Scott is Chief Executive Officer and Chairman of RXR. RXR manages over 30 million square feet of commercial properties with a gross asset value of over $21 billion. RXR also has a multifamily residential portfolio of 8,000 units under operation and development, and over a $4 billion new terminal under construction at our favorite airport, JFK, and an expanding national portfolio and development pipeline in some of the fastest growing markets in the country, including Phoenix, Denver, Raleigh, and Tampa. Before starting RXR, Scott served as the chairman and CEO of Rechler Associates, which he helped to take public in 1995. RXR was founded in 2007, the day after Scott and his partners sold Rechler for over $6 billion, which generated over a 700% return to Rechler investors, of which Cohen & Steers counts ourselves as lucky beneficiaries. Since its founding, RXR has raised over $10 billion of private equity, built over a 500-person, fully integrated team of professionals with expertise in operations, construction, development, and investment management. Scott has also served on the board of American Campus Communities after Rechler took a controlling interest in the company in 1998 and later took that company public in 2004. ACC would grow to become the largest student housing company in the United States and was recently acquired by Blackstone for $13 billion. In his spare time, Scott has held numerous positions in various levels of government. In December of 21, Scott was elected to a 3-year term on the board of directors of the Federal Reserve Bank of New York. From 2011 to 2016, Scott served on the Board of Commissioners as Vice Chair for the Port Authority of New York and New Jersey, and later served on the board of the New York Metropolitan Transportation Authority, the MTA, from 2017 to 2019. From 2017 to 2023, Scott served as the chair of the Regional Plan Association, a not-for-profit organization focused on quality of life and the economic competitiveness of the New York tri-state metropolitan area. Scott also serves as a trustee and vice chair of the National September 11th Memorial and Museum at the World Trade Center. He's a member of the Real Estate Board of New York and the Real Estate Roundtable. He's chair of the Feinstein Institute for Medical Research and a member of the Board of Trustees at Northwell Health Hospital for Special Surgery, and he is a member of the NYU Real Estate Institutional Advisory Committee. Please join me in welcoming Scott as our luminary.
Thank you. Thanks, Brian.
So you're a busy guy.
Actually, I wanted this before we kick off. As Bob was talking, and he was talking about his glass half empty stories. It reminded me the first time I met Bob was I was like 25 or 26 years old, trying to take my family's real estate company, which was a Long Island suburban company, public. And I had to meet with the REIT Mafia, the kings of the REIT Mafia, Bob and Marty, and to talk about a glass half empty meeting, because trying to sell them that Long Island suburban office buildings isn't just about a place where they have bar mitzvahs and there's actually people that actually work there. But ultimately ended up becoming our largest shareholder. But it was definitely a good learning experience from that.
Well, good. Well, you've ever been to Georgetown before? Just curious.
I have been. I have. A beautiful campus. Love it. I was trying to convince my daughter to come to Georgetown.
Excellent. Well, we'd love her in the business school if she's, if she's looking. But look, we're thrilled you're here. We appreciate it very much. I was at the beginning. We were talking about just the conversations we have in class about it being arguably one of the more interesting times in this industry. I mean, we have we're a debt-dependent asset class that's seen the cost of debt go up 2, 3, 4 times, whatever it might be. We're still digesting the COVID implications of how we use space and how we interact. And office has really been the poster child that has painted the entirety of our industry, maybe rightly or wrongly. So, really thrilled that you're here. But so, can you talk to us generally from your Fed board seat, right? You're on the New York Fed. On a macro level, maybe we start sort of top down. What are you hearing relative to banks and sort of their exposure, and what's the conversation in those meetings at more of the macro level?
Yeah. First, I'll just say to your first point on this, I do think different than maybe some of the commentary in the credits panel, that we are at a real paradigm shift for our industry and the economy more broadly, right? In terms of the way that people live, work, and operate. In a pre-COVID world is very different in a post-COVID world. And then the shift in the interest rate regime that we're now experiencing after 15 years of zero or near zero interest rates. We haven't experienced anything like this as an industry since the early 1990s, when we had the savings and loan crisis, and that was really based off of a tax regime that inflated real estate values for a period of time based on a set of rules that everyone followed, and then those set of rules changed, which devalued the real estate. The same thing I think is happening relative to interest rates, right? There was 15 years of people following a set of rules, responsibly borrowing, responsibly lending, but those rules have now changed and they're not coming back. And so that I think is going to create a real paradigm change in our industry, along with what's happening in COVID. On a macro basis, part of the challenge for the Federal Reserve right now, and for any policymaker, is that the playbooks of the past don't work today, and they're using data, looking through sort of the rear view mirror versus looking through the windshield as to where things are going, and really have to sort of carve out a new set of facts to look at to try to assess how things are playing through, right? And they keep saying they're data dependent. It feels right now that they're almost like reading the tea leaves versus data, right? Because the data is very hard, and the averages within the data are skewing what's really happening on the ground, right? I mean, if you really think about it, we have been living in many sectors and many segments in our economy in a recessionary environment for the last couple of years, whether it's manufacturing, small businesses, the lower income segment of the economy, the housing markets in and out, obviously the commercial real estate market. But if you look at the macro numbers wouldn't suggest that we have any recession, right? We have this inflationary challenge. So it's, to deal with those numbers and the averages of this macro growth, they're going to spend more time focused on that. And the byproduct of that is that the industries and segments of the economy that get negatively impacted by these higher interest rates are going to feel more and more pain. And what that likely leads to, this higher for longer is it's going to be higher for longer until the economy breaks. And I think that all of us who've lived through different cycles, if you go back in history, everyone says this time is different until it's not different. And you just never know when exactly it's not going to be different and why it's not going to be different. And that's this concept of a soft landing, I think, is more of a fairy tale than a reality as you go through it. And I think, in terms of how big of a shock we're going to have is unknown. I mean, we talk about financial shocks and we talk about the banks. I mean, we had Silicon Valley. Well, that one was different because it, had this type of situation. We had Signature Bank. Well, that one was different because of this situation. New York Community Bank. Well, that one was different because of this unique situation. The answer is that they're happening because we all have the same problem, right? Interest rates are too high. And I think now that there's been more of a consensus that they're going to be higher for longer than what people were hoping for at the end of last year and the beginning of this year, it's the day of reckoning is going to be accelerated. And I think we'll have more financial shocks. And I do think we're going to see much more distress in the system than was discussed in the last panel. I think there's going to be challenges. And I speak to the regulators this week, and I speak, very senior regulators, senior people at Treasury, senior people at the regional banks, and they don't even think about politics, and they don't think about the ramifications. They say, okay, New York Community Bank went down. There's real estate was the issue. We got to understand every real estate exposure in all the banks around the country. So they take this pro-cyclical approach. By the way, it's not one regulator, it's 3 different regulators that don't really do a great job communicating with each other. And they look at each bank to see what their exposure to real estate is. And they, reduce that real estate exposure. And even though they say publicly, we want them to work with borrowers, their definition of working with borrowers doesn't change the fact that if they have loans that don't meet the credit metrics, then they're not going to be penalized in terms of needing more capital reserves. So banks are going to be forced to have to sell their loans or exit these loans one way or the other. And so it's I think it's this has just been a matter of time. And that's, as I've like to say, and as the banks and I think the real estate industry, this has been sort of the 5 stages of grief. And we're finally getting to like acceptance, right? And now that we're at acceptance, we got to start dealing with it, because if we don't deal with it, it's just going to hang, right? We have to clear the underbrush that exists because of the lower interest rates and the excess liquidity that was in the economy.
So before we go to how we deal with that and how banks are dealing with it, I just wanted to hit a couple things. I mean, I think you said something that the soft landing is somewhat of a myth, and this is going to continue till something breaks, and we're not, it's a little more dire than what you'd hear in sort of the the press on a day-to-day basis. I mean,
That's why I said there's no press here, right?
No, there's no press.
Just want to make sure.
But what does that mean though? What I mean, I think everybody's sort of believing or willing this soft landing to be a reality. But you're not buying that. So what does that look like in your world, and what are you preparing for, given your view on that?
Yeah, I mean, it's very hard, because there's a lot of, as I said, there's a lot of unevenness into how this plays itself through, and there's a lot of other factors that are driving it. So, but again, if you look at for example, the inverted yield curve, we're almost on our 18th month of an inverted yield curve, right? That would be a record relative to an inverted yield curve without having a recession. You go back to even 2008. The 6 months before we had our recession, the S&P was up 40%. Right? You had a situation where the bond prices went up, right? And then we had this big recession. So you don't know exactly when it's going to come or exactly what it's going to affect, but clearly, the interest rates are going to ultimately weigh down segments of the economy. I think the point that someone made earlier here is correct, which is the unique piece of this is a little bit that the larger companies and the wealthier segment of the economies were able to go longer duration on debt. So some of the normal transmission from monetary policy isn't impacting as quickly, and so that could delay what that has been. But you talk to small businesses, look at small business sentiment. It's lowest it's been. You look at credit card delinquencies, look at auto loan delinquencies. Obviously, we've seen in terms of CMBS and other real estate delinquency rates starting to increase. The housing sector has done relatively well for a time like this, but even there, it's so sensitive to a 7% 30-year mortgage. When it's 7% 30-year mortgage, if the rate's above 7%, home builder sentiment drops. If it's below, it goes up, right? So it's a very unique time, but it's just a matter as to where it's going to be. But it's going to be the segments of the economy that are most interest rate sensitive to that. Now, that being said, there's also structural issues, right? And so there are areas like multifamily that in the short term are going to have some major headwinds because of oversupply and the interest rate paradigm shift. In the longer term, it's going to have more tailwinds because of the structural elements of we have a housing shortage. Office, on the other hand, has both a structural issue as well as some supply issues that's going to have to work its way through. So it's going to take longer for that to play itself through. But that's why this is hard, because there's no real example of exactly how this is going to play itself out.
So you talk about, clearing the underbrush, which that to me suggests some amount of scale, right? And we've not seen that thus far. And I want to talk about some of the stuff that's maybe happening behind closed doors, but this is starting to trickle a little bit. But what do you envision that clearing of the underbrush to look like? Like, can you paint that picture for us a little bit?
Well, I mean, listen, and again, this is a little bit where when you think about the quarter as an example, has helped maybe soften a little bit some of this, right? Because when Powell came out and gave the what I call the Powell pivot, right, in December 13th at his press conference, his commentary was so dovish. It was probably like the equivalent of dropping rates by 100 basis points in the short term. Yep. And that, I think, you clearly loosened the financial markets, the bond markets, right? The equity markets see more IPOs this year than in the first quarter. I think all of last year or close to that, right? So it's changed that, it's given people a chance to equitize a little. But really what needs to happen is we need a deleveraging of the whole system. And that's, again, real estate as well as corporates and small businesses that ultimately have to find ways to re-equitize and adjust for not only the interest rate, but the new values associated with where they are. And so that's a process. It's not going to be like 2008, where we're going to have this big injection of capital and it's almost like a morphine and we went from down to up. So it's not going to be V-shaped. It's probably going to be, we're going to hit a bottom, and it's going to be a longer, more drawn out sort of, a death by 1,000 cuts process as loans start to mature. And that's why it's not just in real estate, again, because I don't want to leave that, but look at the S&P 500, last year, up 20% new high. The Russell 2000, the small businesses, down 20%, right? So there's a real dislocation in the economy right now in terms of, or differences in terms of which segments are being impacted or not. But a lot of those businesses have debt structures that are not sustainable.
So let's talk about some examples, right? In our organizing call, you kind of referred to the fact that there's a lot of this stuff sort of happening behind closed doors, not exactly wanting this to be made into public, into the OMs and things like that, so to speak. So, what are some examples of what you're seeing in terms of purchasing, restructuring, re-equitizing that you can share with us in terms of what's happening right now?
Right. So, another sort of difference that we've had in other cycles is the run on the bank scenario is very different than it was in the past, because the communication and the speed in which people can pull money out of the banking system, the transparency of what banks have on their books are much more available to the general public. So whether it's rating agencies or shareholders. And so when you deal with lenders, they really are trying to quietly address their problems before it gets to a point where it then becomes public, because when it becomes public, it becomes too late. I mean, look what happened with New York Community Bank, right? I mean, for months, they were trying to deal with what they knew was happening. And then, as soon as it started to leak out that they were having some problems, as the stock began to crash, they had to execute a trade.
Yep.
And there were many of us that were in there knowing that something was going to happen at some point, right? So what you're seeing is, banks are trying to quietly take reserves, and then when they have enough reserves, begin the process of identifying where they can force parts of their loan portfolio to be sold, which is what the regulators are telling them to do, is reduce your corporate commercial real estate exposure. The office buildings, they'll take the greatest discounts on. So then they focus on multifamily or logistics, because that's the most liquid, and they can move that paper, or they can force the borrower to refinance them, or by selling or refinancing. It may not be at a price that they would like or terms that they would like, but it's better than the alternative as you go through that. So you're seeing that happen. I think you're going to see that more with insurance companies as well. And we're seeing that happen with the LPs, limited partners, institutional limited partners, that just want to remove real estate from commercial real estate, particularly office, from their books. And if they can get money back to repatriate to their investors who are demanding liquidity, that's what they're seeking to do as they go through that process. But these are, and that's why I don't think it's happening as quickly, because they are one-off conversations. No one really knows the terms. There's a lot of structure and financial engineering done to help minimize losses as they go through that process. But as they do become more public, I mean, we're working on a number of transactions ourselves, or have done a number of transactions that, we basically sign confidentiality agreements on. But once these things start to become public, they will be a model which others can then start to follow. And we've seen in other cycles before. And again, this is why I think it's much more like the early 90s than 08. It took a bit of time to get the infrastructure in place, for people to think through what's the playbooks, what's the structure, what did this person do? And then once you see your peers start doing it, if you're a bank or if you're an investor, it becomes more normalized. And ideally, it will be a situation where this can happen, where the private sector can handle this itself, and the banks will take losses and the equity holders will take losses and will re-equitize. But I would say it's probably unlikely, because it's such a large scale problem. And in my conversations with regulators, what I have said is, you need to be proactive here, right? Because if we're not proactive and try to find a way to help expedite this re-equitization, then we're going to ultimately have a situation where they're going to have to bail out an industry they don't want to have to bail out. And that's like the political disaster. But the problem is in government, right? They're good at doing the bailout. They're good at, responding to a crisis, but they're bad at proactively taking steps to try to prevent the crisis, because that takes more political courage to do, right? But there are a couple of things that they could do, I think, that, would help facilitate that, we've put in front of them, and maybe they will do it, but that I think would be helpful.
Can you talk about any of that?
One example that I've laid out with a couple of other people, for example, is start by trying to encourage new lending, right? Because part of the problem is the plumbing's clogged. Banks that are being told reduce your commercial real estate exposure, and everything's being painted with the same brush. If they can't get their existing loans off their books, they can't lend to new borrowers. So one concept would be to actually put out guidance for all lending institutions as to how you characterize legacy loans versus newly originated loans, and have the regulators evaluate those loans differently. The rating agencies could evaluate those loans differently. Shareholders could evaluate those loans differently. And then hopefully banks would be encouraged to lend on newly originated loans with the benefit of the transparency of the current market environments, the current rate environment, and it would be compelling, and because they have to pay more for deposits, so they could at least earn more on their interest, right? And then eventually that could get the cycle flowing. If it doesn't flow, by putting that distinction between those loans, you can then put an asset loan program in place, like a term asset loan, like TALF, like we had in the 08 period, but where you can then, as a government, try to inject liquidity only for the newly originated loans. So it's not a bailout because you're not dealing with the old loans, but you can actually supercharge and make it more economically advantageous to actually originate new loans, which again can help get the plumbing started again to ensure that we can force this re-equitization.
So, I mean, you talked about maybe the private sector not being able to handle it themselves. I mean, what do you think the odds are that that is a reality, that the private sector won't be able to address the problems themselves, ourselves?
I think the scale of the market's so big, right? You're talking $2 trillion alone. So it's not, there's a lot of capital on the sidelines, as we all keep hearing about, right? For the more opportunistic part, the subordinate pieces of these capital structures. The harder part is the senior part of the capital structures, right? The 0 to 40% piece of the capital structures is the hardest part. And so that's where I worry about it not being able to be handled. Example of even another thing, I was with a very senior level regulator this week, and they were worried about non-bank lenders and the lack of transparency in non-bank lenders, and wanting to talk about regulating non-bank lenders. And the reality is right now, they should be leaning into non-bank lenders. Like, they should be encouraging non-bank lenders to be a conduit to help move some of this paper off of the bank's books, and maybe even just let the banks be incentivized to lend to non-bank lenders in a more secure position and help facilitate that, right? But they're not thinking in that way. So that's going to be the challenge. And so unless there's some change in psychology, which probably is going to happen because of financial shocks,
yep,
then it probably does become something that we're going to need to have the government get involved in.
So just, if you have questions, you can tweet them at me, and I'll be looking at my phone here periodically. But I'm going to pivot a little bit. You have an RXR white paper on sort of essentially your strategy, and you set the stage by talking about the crossing of the chasm, right? So can you talk about what that is? What is the chasm, and what's on this side and what's on the other side, and how we're going to get there?
So we every year at RXR, we write a white paper, and we started doing this probably almost 18 years ago. And I think it's one of the reasons we sold our company in 07, which is that we try to drown out the noise of everything around us and just try to think about what do we see, and what do we think the future holds. And last year, 23, if you remember going into 23, everyone was negative. We're going to have a recession. And our view was that the concept was we were going to leave this COVID world and get to this new normal. And crossing the chasm was getting to the new normal of the post-COVID world. What turned out to be the case was actually people got to the chasm and saw all this fear about potential recession between, the interest rates going up, inflation, the financial shocks in March, the geopolitical issues. And I think people got paralyzed in 23. And that's why we didn't have the transaction activity. And in 24, our view is that now we're going to start crossing this chasm, right? And I think, when you get through this process, and this is to the point when you can clear the underbrush and get to the new normal, we're very, very bullish about the prospects for the U.S. economy. I mean, when you think about where we are as an economy and the amount of innovation that took place during COVID in technology and science and medicine, and then the amount of dollars being invested on the decarbonization, the digital transformation, the deglobalization, both the onshoring and now remilitarization, unfortunately, that we're going through, this is going to be like a post-World War II moment for the U.S., where we're going to have a level of above-trend growth for a number of years. And that's why the sooner we sort of can have the day of reckoning and clear, the past and focus on the future, I think while it's going to be painful, it's going to be healthier when we can get there. So it's when we get to the other side of the chasm, we're very bullish, and that's really the point of what that chasm is. Getting there is much harder, and I think certain, as I said, industries and segments of the economy are going to find that journey to be, some may just work their way right over it. Like if you're in the digital transformation space. I sit with the CEO of IBM on the Federal Reserve Board, and every 2 weeks when he tells me how good the economy is for his business, and then he comes to my turn. It's like, it's not great, but then some will do that, and some are going to have to work their way, around it. And it's going to be a little bit more turbulent.
So, I mean, what's your view of how the real estate industry and the office industry in particular is going to, address that chasm? I mean, we've talked a little bit about it via the sort of the loans that we got to, clear out, but is that a 18-month? Is it, what's your sort of prognostication for how long it's going to take us to get to where you're very bullish about the future?
Well, again, I'm going to leave out the office industry for a second, because I think that's got a longer period of adjustment ahead of it. But I think it's, I like to say, I quote Sam Zell, but I add to it, right? He used to say, survive to 95. I say survive to 2025. The fix is in 26, and if you make it, heaven in 27. So figure out that math. That's whatever the timeline is. That's what I keep telling my son. So he's because he works with us, and he says, "What the hell is this business all about?" Right? But but I think that is the path. But some sectors are going to have a harder time, and I think office is one that is a harder period of time. And just maybe to pivot into office for a second, but in Bob's commentary. In that glass half empty commentary, it's hard to argue with it. And I would say we're not arguing with it. I think that our view is, as a macro bet, I would not bet on a macro, put all your chips down in office. And every market is different. And there's many more markets that are going to have structural challenges than are going to recover as quickly as you'd hope. And then every building is different. And so you really have to pick, almost like a stock picker, which of the buildings that are going to be competitive in the post-COVID world. And so this is a very, you got to be really careful about, on the office side, just saying I'm all chips down in office, right? Because that's not the case. And I think, when you look around the country, New York has, been an incredible recovery because it's a magnet for talent, right? That's what drives New York. Talent wants to live there. Talent wants to work there. It's built an ecosystem of culture, quality of life, opportunity for jobs, career paths that has made it a place that is something that drives the talent, which then brings the businesses and becomes this self-reinforcing positive economic cycle. Miami has done something similar, although much smaller in scale. In there, and then there are other parts of the country that have, but then there are other parts where those downtowns, where those office buildings are, like the Wall Street Journal article in St. Louis, right, or in Indianapolis, they're ghost towns when people aren't in the office. There's nothing else to do, right? So if you're not a live, work, play type location, that's a challenge, right? And I think that you know the good news on office. So I make sure I get this. It says is the fear that people had about is there a future of office? I think in terms of people having to go to work has been resolved. Hybrid work is here to stay. But hybrid work means you need an office, and whether it's 3 days a week or 4 days a week or maybe 5 days a week, you know, you're going to need office space. It's going to be a different type of office space, and so you got to find the places that have the type of offices that people want to be at, the type of locations that are easy to get to from proximity standpoint, that have amenities in the buildings and amenities around the buildings, neighborhoods that are safe, that are engaging, that have good restaurants, good activity, good energy. All those things are factors that you have to put into place when you're thinking about, you know, where you're going to invest in office. So our mandate, we can invest in any city in the country, but we haven't invested anywhere in New York, and it's going to have to be a very high bar before we would.
So, you know, if you kind of read some of the stats out there, it's basically office built on or after 2015 in good locations from an amenity standpoint is, you know, performing well, right? But you made some comment about, or a comment about, you got to be very careful about that. So what's the situation where something that would ostensibly look good on paper from an office standpoint, age, amenitized, just doesn't play, right? I mean, where does that, because it seems to be a fairly clear sort of bifurcation between what is actually performing and what isn't. You know, where do you get burned on the stuff that may be something that actually looks good when you're
well, I mean, I would counter your point, right? Because I don't think age is necessarily one of the drivers. Like the Empire State Building is actually doing well, right? You know, we have the buildings that are 100 years old, like our Star Lehigh building that is doing well. It's just it's really, you know, you have to be much more granular. And at the end of the day, I think you mentioned earlier, or Bob did, about the mall space, right? And that, you know, what happened in malls, and there is a lot of an analogy to what happened in malls to what happened in office, although there are some significant differences. You know, the malls that survived e-commerce, the wave of e-commerce, were the ones that were easy to get to, the ones that became destinations and outings, and were able to be as much entertainment as it was a place to shop, right? And then it was worth doing it. And you know, I think on office it's similar in the sense that it's the ones that are easy to get to, the ones that have the type of space and amenities that people feel good about being there, have places to collaborate and come together with your peers, right? This is all about, you know, ideation and getting mentorship and apprenticeship and building culture. And so you want buildings that help accomplish that goal, and that's the space and the neighborhoods. So, you know, one of the big key things is proximity to transportation, being in 24/7 live work type play environments, so people can live to and walk to work if that's what they want to do, or they can they have, you know, restaurants that can survive the urban ecosystem if it's only a 4-day a week work week. So that, I think, is more of what doesn't work. And for us, you know, when we look at investing in an office building now, we look at how much tenant activity is happening in those buildings or the surrounding buildings where there's similar type buildings with the similar type spaces. And again, the world's different. We have transparency of that now. Like in the old days, we had to wait to see, you know, when a CBRE or Newmark or Cushman & Wakefield put out a report looking backwards. Today, we have tools with like VTS that we see the tenants that are looking at space. We know every, you know, at any moment in time, we could tell you how many new the requirements are out there, what type of industry they're in, where they're looking, what type of spaces. And so you have a competitive landscape. Now, I can get that information anonymized. I can't tell you exactly what building, but I can tell you exactly how that would compete. And so you want to see that level of activity. You want to see foot traffic. You know, look at your mobile, you know, cell records, transportation records. You could see the energy and activity in those areas. And that's where you ultimately want to invest.
So this conversation is basically discussing the future of office as an investable asset class. And in that same white paper, you have what you're calling Project Kodak, right? So maybe talk about what Project Kodak is and what that means relative to your strategy from an investment standpoint.
So in the beginning of 23, I asked our team to look at our own portfolio and say, okay, which of our assets would be competitive in the post-COVID world and which ones wouldn't be. And we called it Project Kodak after the film company, right, who didn't make the move to digital versus film, and asked them all to characterize that. And we went through our own portfolio. And to your point, it forced us to be much more objective as to what are the metrics you're looking at. And the first go around, everything came out almost the same. And there was like almost no film. And I said, this can't be possible because we're not leasing some of the space. So we even then started to put weightings. And the other decision we made is we took out the capital structure because, if the capital structure was there, it could influence us to not invest in a building if we could fix the capital structure, right? So we said, let's do this without considering the capital structure and go through that process. And so we ranked all of our buildings as to what's digital and what's film. And the concept was that we're not going to put good money after bad. None of our buildings were cross-collateralized. There's no guarantees. And we were going to defend and invest in the ones that made sense to be competitive, and which we have. Last year, we invested $1.2 billion into our office portfolio of digital assets. And the ones that are film, unless we can come to terms with a lender where we can buy it cheap enough to convert it to a different use, which we are doing, we would walk away from it. And we came out very publicly after we went through that process to make that clear, because I want our stakeholders to be clear that that was, and I want our counterparts to know that that's how we were approaching it. It was a little cathartic, and it was good internally for us to get focused on things. And then we've done that for the rest of the market in New York and said, okay, what's digital, what's film, and take what's that lens that will filter these buildings through, and try to make a determination is worth investing to keep as an office use or not.
So maybe in that same line, we talked, or obviously there's a JV between RXR and Aries to go out and buy office in New York City. Can you talk a little bit about what that capital is looking at, and are you transacting, or are you, what does that look like?
So interestingly, when we went out and did this, we had some people come to us, they're interested. Is this a generational moment to invest in office, right? Is this a moment where, like going back to sort of the Olympia New York days in the 70s, where you could buy things so cheap that would maybe make some sense. And so, but our traditional investors, none of them wants to touch office, right? I think someone up here said, it was Peter, like office is toxic, right? It's a toxic concept. So Aries really started with their special situation group and approached us and said, we think as a macro, this could make sense if you had someone that could help pick the right buildings. And once you pick them, actually execute on a strategy to make them valuable in that mix, right? So, so that really has been what started that relationship. And then we have $500 million, which can go to $1 billion. And the other big segment, which has been interesting, of a lot of incoming inquiries that are investing with us, are some of the ultra high net worth family offices, big ones that say, and the advantage is it's an investment committee of one, right? They don't need to have to go to someone else and go through the process of having to advocate for investing in office right now. And so we have been transacting, and we basically 3 areas that we focus on. One is we'll buy loans from banks, and we have a number of offers into banks to buy loans. The concept with the buying loans from banks is not to really buy distressed loans, but loans that have upcoming maturities or need capital because of rollover in buildings that we would deem to be digital, with a loan basis that we think is reasonable. And in that instance, we're not looking for a crazy discount, but maybe it's a 10 to 15% discount. But we are looking for financing against an SPV, which enables the lender to dramatically reduce their cost of capital that's held against that loan, right? So you can make a win-win for the lender and for us in that mix there. The second is good news money, where there's buildings that are good buildings, that have sponsors that are good sponsors, but have LPs that aren't investing today. Right? The LPs don't want to put more money into the office buildings, so they may have the ability to lease the building. So it's a good building with a broken capital structure, that if we now can provide them the capital, they can lease the building. In that case, we'll come in, and most of the time you try to be $1 above debt, but sometimes we're actually coming in inside the debt stack to provide the capital, get a preferred return and a share of the profits. And then the third is buying LP interests. So those same LP players that don't want to invest in their own capital, they want it off their books. And if you just think about it from their shoes, you know, they made investment in office. The appraisals are crashing through the floor. They haven't, the possible, the Odyssey funds, they haven't even been really recognized purely in the indexes. The banks haven't really recognized. Most banks ask us not to send them an appraisal because they don't want the appraisal, because they don't want to, they get it, they have to deal with it. But when you look at the numbers, if someone invested $100 million in an office building, and maybe now it's worth $5 million based on that appraisal, and they need to invest another $100 million to re-tenant it today, they don't want to go near that office building. So we've been buying from LPs in the buildings that we think make sense, their interest for cents on the dollar. Some of them, I would say, is option value, where, you know, frankly, if you looked at today, there's not value based on where the debt is. Some of it's in the money, but needs more money, right? And the ones that, and so you have to underwrite it, like basically you only need a couple of them to work to actually make this investment work. But what you're really buying is the ability to sit at the table and then negotiate with the lender, restructuring the loan. Because again, this isn't like 08. So you're not going to buy and assume values are going back up. You have to reduce basis. This is all about getting a basis that's reset for what this new normal is, or you don't really want to own this on the other side of that. And so we negotiate with lenders, we bring capital, and we bring the capability to lease space. Right, so we're bringing tenants and we're leasing space and we're bringing capital, so we're enhancing their collateral, and we're funding it. In exchange, we ask them to take their loan and convert it into an A note and a B note, where the A note's reset to a spot that makes sense today, and the B note's a hope certificate that's subordinate to us getting, 20+% returns, and so. And so we've done right now 3 million square feet of Class A LP interest as an example, that we're in the process. And we have 5 of them that are now where we have meetings of the minds with counterparties and lenders to reset the capital structure in that context. Our biggest challenge, interestingly enough, is we've been leasing faster than we can negotiate the deals with the lenders. So we're taking buildings that have big vacancies, WeWorks and other things like that we release it. And now the tenants want us to get leases signed and get non-disclosures and everything else. And we can't go to the lender because we're in the middle of negotiating a restructuring of the loan, right? So gets where it gets a little bit challenging right now.
So, I mean, talk about the leasing. Like, what are the themes of the conversations you're having with the tenants that you're in negotiations with? I mean, is there anything interesting to glean with how they're thinking about space, how they're allocating space, how they're expanding, contracting? I mean, what sort of themes are out there?
There's been a big shift since Labor Day of last year. Going to the beginning of last year again, and I remember sitting in a Fed board meeting, and the CEO of NASDAQ is in there, and she says, every one of my companies has said they're going to have 25% less office space. And I was like, oh my God, I mean, that's NASDAQ. Every one of our companies is going to have 25% less office space. And that was a little bit of psychology. And the psychology really was coming from the top, not from the real estate people. It was coming from the CEO and the CFO who says, we don't need as much real estate. Why do we need as much real estate? And so they were mandating it. But now what you're seeing as companies are actually trying to put people back in space, they realize, wait a second, we really do need more space. So most companies that had said they're going to cut space dramatically, other than the tech companies that committed to space, have found themselves short of space and have had to take more space in the context of things. Labor Day was, I think, a acknowledgement that, okay, we are coming back to work, at least in New York. Everyone's coming back to work in some form or some way. And so there was a big shift in activity of tenants looking to find space in the market. And, I mean, a good example that we had is Paul Weiss. It was a tenant of ours at 1285, and it was widely reported, is leaving 1285 because we couldn't accommodate their desire to expand by a couple 100,000 feet. That's 500,000 feet. They're moving up the block. When they moved up the block, they knocked out some other tenants that were going to be in that spot. In their 500,000 square foot block, within a month, we had another tenant that came to us and we want that space. In a month, right? 500,000 square feet. So it highlights, and that there are, when you have the right space in the right area, there's tenants that want there. my team in their negotiation were getting really pushed down on rents and concessions, et cetera. And so in December, I said to the team, I said, just do me, let's go to the tenant and respectfully tell them just the space is off the market. With the tenant, the space doesn't come due until 26. It's not worth us giving it away at these prices. I'd rather just hold it and take the risk. P.S. 2 weeks later, I was in the office of the tenant for the phone call, and our net effective rent is up 15% higher than where the last deal was, because they want the space. And so if you have the right space in the right location, there is a little bit of a scarcity value. And part of it is that people don't want to be in the Class B space. There's a wide variance in Class A, and a big portion of Class A space is zombie space because it has capital structures that can't be financed to work. So when you start narrowing it down, and brokers know that. I mean, they know which buildings don't have the capital structures to actually put the tenants in. So it creates an interesting dynamic. We leased 2 million square feet last year in our portfolio. In the first quarter, we have 1 million square feet of leases out for our portfolio right now, right? So you're seeing financial services, private equity, hedge funds, consumer products, marketing, not tech.
Yep.
Not tech yet, at least.
So if we go back just to the capital for a minute, you know, a lot of these open-ended core funds have a lot of exposure to office for obvious reasons. Do you think that the sources of capital changes, right? Like we've gotten burned. It's a capitally intensive asset class. It's just not in the go forward investment strategy for the firm. I mean, do you think who's investing in that on the other side of the chasm is different?
Probably some. I mean, again, use malls as an example, right? I think what ended up happening in malls was the tenants, the people who started to go to the malls that were able to perform, the tenants started to go there and pay rents and real rents in those malls that are performing. And eventually the institutional capital began to reprice those malls and be attracted to those malls because it made sense, right? And so I think the same thing's going to happen to office. If some are really, really burned, maybe they go away, but we're already now at the point of the cycle, which many of us have lived through, that almost all of my institutional capital players that actually made those investments are gone, right? And by the time we continue through this next 12 months, a lot more are going to be gone because they don't want to live through it. They don't, most of it's by choice. And so someone else who didn't make the investments there, and someone else will probably be there by the time to make the next investment 3 to 5 years from now. But it's hard. I'll just close the office thing with this point. I think Peter said it before, which is how do you value an office building, right? There's not an easy answer to that question. Even a good building, there's not an easy answer. So what we look at is what's the price per pound, right? Really, what is that price per pound? We don't assume we're going to see rent growth. We say the market is what the market is. And we say if we can get this leased up in this current environment and get an 8% NOI yield, I'll take the bet. Right? Good building, leased up, today's rents, no rent growth, 8% NOI yields. I'll take the bet that there's some contraction for those higher quality buildings in the future.
So as we begin to draw this to a close, you actually made mention to your son who's at the company. I mean, as a dad here and as also a real estate professional, what are you telling him about, where we are and sort of where we're going and look, man, this is a phenomenal opportunity, right? Just hang tight, learn, or this is ugly, right? So I mean, what's the internal conversation going on around that with a room that's probably at least half students here?
Yeah. Well, for my son, I'm like, hang in there. You could do this because it's it is. I came into business in 1990, right? Yeah. So I lived through a very similar situation, my family business and a lack of clarity. And what I would say is, and I say this to students all the time, is that is the greatest opportunity, right? Because when you're going into an industry that's going through a paradigm change, your ability to see things differently and approach things differently without being burdened by all the things that we have lived through as we take for the norm is an advantage that you should embrace. And at the same time, the industry is going to go through so much change that if you're embracing it and leaning into these different changes, you can, be, as there's this transition, you'll be the next leaders in this industry, right? And this is the moment of time where they're set And you go back and look at history, they're set during moments of chaos, right? And I always tell them this, chaos before clarity. So let's get through the chaos, and then you ultimately will have that clarity. But it's a great learning experience. But it's also one you got to have confidence in yourself.
Yep.
And more, I'd say, even than when we were the big other things besides the industry stuff. I mean, technology and AI and all the different ways that people are going to operate differently, again, is a big advantage for young people to lean into that as a differentiator.
So just the last question here. So if you think back to your 22-year-old self, I mean, there's a lot of them in the audience here. What advice do you wish somebody would have given you as a 22-year-old that would have either saved you time or, whatever it might be, that maybe took you a little bit longer than you'd like to figure out on your own?
I guess I would say things in life have a way to work themselves out, right? And so when things are really good, stay humble, and when things are bad, get hungry, and you'll work your way through them. My father-in-law used to always tell me, sometimes you're the top dog, sometimes you're the fire hydrant. It's like, so don't get too full of yourself when things are good, because, they don't, you can't get complacent, because when you get complacent, something goes the other way. And when things are bad, don't put yourself in a spot where you get paralyzed, but actually rise to the occasion. And that's when you get hungry and, fight your way through that. And you'll build character and become better because of it.
Well, Scott, we certainly appreciate you coming to Georgetown. It's a thrill to have you here. You're the right guy at the right time. I know our students will have a lot and you'll be able to take a lot out of this. I look forward to talking to them next week in class. But can you join me in actually thanking Scott here for coming to Georgetown?
Thank you. Thank you. Thank you, my Scott. Thank you.